What is accounting?
Accounting is the process of recording, summarizing, analyzing, and reporting financial transactions of a business to provide useful information for decision-making. It serves as the language of business, helping stakeholders understand financial health.
What are the main branches of accounting?
The primary branches are financial accounting, which focuses on external reporting, managerial accounting, for internal decision-making, tax accounting, for compliance with tax laws, and auditing, for verifying financial statements.
Who are the primary users of financial statements?
Primary users include investors, creditors, regulators, management, and employees. They use the information to assess profitability, liquidity, solvency, and operational efficiency.
What is GAAP?
GAAP stands for Generally Accepted Accounting Principles, a set of standardized guidelines used primarily in the U.S. for preparing financial statements to ensure consistency and comparability.
What is IFRS?
IFRS stands for International Financial Reporting Standards, a global framework for financial reporting adopted by many countries to promote transparency and comparability in financial statements.
What is the accounting equation?
The accounting equation is assets equals liabilities plus owner's equity. It represents the fundamental relationship showing that a company's resources equal claims on those resources.
What is double-entry bookkeeping?
Double-entry bookkeeping records each transaction with equal debits and credits to maintain the accounting equation. Every debit must have a corresponding credit, ensuring accuracy and balance.
What are assets?
Assets are resources owned or controlled by a business that provide future economic benefits. They are classified as current, e.g., cash, inventory, or non-current, e.g., property, equipment.
What are liabilities?
Liabilities are obligations of a business arising from past transactions, representing claims by creditors. They include current liabilities like accounts payable and long-term ones like bonds payable.
What is owner's equity?
Owner's equity represents the residual interest in assets after deducting liabilities. It includes owner investments, retained earnings, and accumulated profits.
What is revenue?
Revenue is the income earned from normal business operations, such as sales of goods or services. It is recorded when earned under accrual accounting.
What are expenses?
Expenses are costs incurred to generate revenue, such as salaries, rent, and utilities. They reduce owner's equity when matched against revenues.
What is a chart of accounts?
A chart of accounts is a list of all accounts used by a business to classify transactions. It organizes accounts into categories like assets, liabilities, equity, revenues, and expenses.
What is a journal in accounting?
A journal is the book of original entry where transactions are recorded chronologically with debits and credits. It provides a complete audit trail before posting to ledgers.
What is a general ledger?
A general ledger is a complete record of all accounts and their balances, summarizing transactions from journals. It forms the basis for financial statements.
What is a trial balance?
A trial balance is a list of all ledger accounts with debit and credit balances to verify equality of totals. It detects arithmetic errors but not all mistakes.
What is accrual basis accounting?
Accrual basis accounting records revenues when earned and expenses when incurred, regardless of cash flow. It provides a more accurate picture of financial performance than cash basis.
What is cash basis accounting?
Cash basis accounting records revenues and expenses only when cash is received or paid. It is simpler but less accurate for matching revenues and expenses.
What is a balance sheet?
A balance sheet is a financial statement showing assets, liabilities, and equity at a specific point in time. It reflects the accounting equation in detail.
What is an income statement?
An income statement reports revenues, expenses, and net income over a period. It shows profitability. Net income equals revenues, expenses.
What is a statement of retained earnings?
The statement of retained earnings shows changes in retained earnings over a period, starting with beginning balance, adding net income, subtracting dividends. It links income statement to balance sheet.
What is a cash flow statement?
A cash flow statement summarizes cash inflows and outflows from operating, investing, and financing activities. It explains changes in cash balance over a period.
What is depreciation?
Depreciation is the systematic allocation of the cost of a tangible asset over its useful life. It matches asset cost to periods benefited, reducing taxable income.
What is straight-line depreciation?
Straight-line depreciation allocates equal expense each year, cost, salvage value, / useful life. It is simple and widely used for assets with steady utility.
What is FIFO inventory method?
FIFO, first in, first out, assumes oldest inventory costs are sold first. It reflects current costs in ending inventory during rising prices.
What is LIFO inventory method?
LIFO, last in, first out, assumes newest costs are sold first. It is allowed under GAAP but not IFRS, often used for tax benefits in inflation.
What are accounts receivable?
Accounts receivable are amounts owed to a business by customers for credit sales. They are current assets converted to cash upon collection.
What are accounts payable?
Accounts payable are short-term liabilities owed to suppliers for purchases on credit. They represent obligations payable within 1 year.
What are current assets?
Current assets are resources expected to be converted to cash or used within 1 year, such as cash, receivables, and inventory.
What are non-current assets?
Non-current assets, or fixed assets, are long-term resources like property, plant, equipment, and intangibles, used beyond 1 year.
What is the matching principle?
The matching principle requires expenses to be recorded in the same period as related revenues. It ensures accurate profitability measurement.
What is revenue recognition principle?
Revenue recognition principle states revenue is recognized when earned and realizable, not necessarily when cash is received. Key criteria include persuasive evidence and delivery.
What is the conservatism principle?
Conservatism principle advises understating assets or income and overstating liabilities when uncertainty exists. It promotes prudence to avoid overstating performance.
What is materiality?
Materiality refers to information significant enough to influence decisions. Immaterial items may be accounted for differently for efficiency.
What is the going concern assumption?
Going concern assumption assumes the business will continue operating indefinitely without liquidation. It justifies capitalizing assets over their useful lives.
What is the monetary unit assumption?
Monetary unit assumption states financial transactions are recorded in a stable currency unit, ignoring inflation effects.
What is the economic entity assumption?
Economic entity assumption treats the business as separate from owners and other entities. Transactions are recorded distinctly for the entity.
What is the time period assumption?
Time period assumption divides business life into artificial periods like quarters or years for reporting. It enables periodic financial statements.
What is the cost principle?
Cost principle requires assets to be recorded at historical cost, not market value. It provides objective, verifiable amounts.
What is the full disclosure principle?
Full disclosure principle requires all relevant information affecting decisions to be disclosed in financial statements or notes.
What is the current ratio?
Current ratio measures liquidity, current assets/current liabilities. A ratio above 2 to 1 generally indicates good short-term solvency.
What is the debt-to-equity ratio?
Debt-to-equity ratio assesses solvency, total liabilities/owner's equity. Higher ratios indicate more leverage and risk.
What is gross profit margin?
Gross profit margin is gross profit/revenue, x 100, showing profitability from core operations before overhead.
What is return on equity, ROE?
ROE measures profitability for owners, net income/average equity x 100. Higher ROE indicates efficient use of equity.
What is the accounting cycle?
Accounting cycle is the process from recording transactions to preparing financial statements, journalize, post, trial balance, adjustments, adjusted trial balance, statements, closing, post-closing trial balance.
What are adjusting entries?
Adjusting entries update accounts at period end for accruals, deferrals, depreciation. They ensure accrual accounting and proper matching.
What are closing entries?
Closing entries transfer temporary accounts, revenues, expenses, dividends, to retained earnings at period end. They reset accounts for the next period.
What is a post-closing trial balance?
Post-closing trial balance lists only permanent accounts, assets, liabilities, equity, after closing. It verifies debits equal credits for new period start.
What is an accounting worksheet?
An accounting worksheet is a multi-column tool aiding adjustments and statement preparation. It includes trial balance, adjustments, and statement columns for verification.
What is bank reconciliation?
Bank reconciliation reconciles company cash records with bank statement, identifying timing differences, errors, or theft. It ensures accurate cash balances.